Investing in REITs, or real estate investment trusts. This is one special method that you can start invest in real estate, with little money, and not having to manage the actual property. So what is REITs? It is actually investment trusts, that invest into real estate. REITs own investment properties and collect rental. It also sometimes sell the properties to make profit. REITs can sell shares to investors. Its share can also be listed on stock exchange. So you can own them very easily. Investor who owns the shares will be entitled for dividend, which is from renting or selling properties. Normally the public listed REITs has to distribute 90% of their income, as required by law. Hence, REITs investors can expect regular cash distributions every year. The money normally is distributed every quarter. Why invest in REITs? As REITs shares are traded on stock exchange, you can buy the shares easily with little money, normally in hundreds of dollars. This is much less than the amount you need to pay to own actual property. REITs can regularly give you decent payout, as they receive regular rental from the tenants of the properties. This payout is in the form of dividend, which is given out every quarter. The dividend usually ranges somewhere between 4 to 8% per annum. Sometimes higher depending on the share price you buy. Owning REITs share, you have the professional trust managers, to manage the investment properties for you. Hence much less work compared to owning a property on your own. REITs shares can be easily bought and sold on stock exchange almost instantly, hence it is a lot more liquid compared to property, which takes weeks or months to purchase or sell away. To buy REITs is quite simple. You just need to open a share trading account, and then looking for the right stocks to buy. All the steps of buying a REIT stock will be guided by your stockbroker, when you open the account with them. However, before doing that you need to understand the REITs, which you are going to invest in. As it does not guarantee you always make money with REITs. Yes, you can always get dividend from REIT, but what if after you buy into a REIT stock, the stock price reduces by half? Therefore, understanding is important. Firstly, you need to know the type of REITs out there. Generally, there are 4 main types. Commercial REITs, which invest in shopping malls or offices. Industrial REITs, which invest in industrial buildings, data centers, or business parks. Healthcare REITs, which owns hospitals and nursing homes. Hospitality REITs, which owns hotels and service departments. There are also mixed types, which invest in different type of properties. However, we recommend new investors focus on one type, that you think has the most potential, in medium and long term in your location. Try to invest for long term, as it has been proven to be most profitable, and able to reduce risk of losing money significantly. Think about 5 to 10 years down the road. Will this type of property and REITs still be around? Will there be more of this type of property, or there will be less? Will people still need to use this type of property? If the answer is yes, there is a good chance this REIT will do well. To assess a REIT as an investment, we will use 3P system: the prospect, the people, and the price. A. The prospect. As mentioned before, to increase the chance of making money, and reduce chance to lose money, you need to assess REITs based on a long-term approach. That is to see them in 5 to 10 years from now. How will the type of properties that the REITs invest in be? One important thing you need to take note, is the market and the industrial trench. For example, with the rise of e-commerce, which will be likely to stay with us for quite a while, what will be the beneficial type of property? The answer is industrial and logistic type, like warehouse and logistic building. Another beneficial one would be the data center, which supports the network infrastructure. On the other hand, the type of property might get adversely affected as shopping mall, as people move from shopping at brick-and-mortar shops to online shops. Then also ask the question, the REIT in consideration, can it cope with the changes in the market and in the industry, in the next 5 to 10 years? Based on their past performance, are they growing and scaling down? If they are growing, chances are your money investing into them also grow too. We can assess more of it, when come to the price and the number. You can also think about it, as if you are investing into the properties. Which type of properties you would want to own, and hold for a long time. Similarly, you would want to own a REIT, that invest into those types of property. After going through the first P, prospect, you are now able to narrow down your list of REITs that you want to invest in. Be it industrial REITs or commercial REITs, or even more focusing like data center REITs or office REITs. That is not good enough. The REITs can only continue doing well if they have a good management. That brings us to the second P, the people. Here, we talk about the people who are managing the REITs. You need to assess them too. Our advice is to browse through the REITs director's profile. Normally, you would be able to find them on the REITs website. The key directors and managers should have three important characters, which are REIT knowledge, REIT experience and REIT attitude. REIT knowledge: are these key directors and managers possess good knowledge of the industry and the properties they are investing in? This can be found in their education and relevant working experience. REIT experience: here, it refers to the experience of the key director dealing with REITs and property types. An office manager can have a very different experience compared to a shopping mall manager and so on. Has the key manager and director gone through several cycles of property market? How have they performed, especially during the bad time? Are they regularly changing their job, or have been with the REIT for a long time? Last but not least, the REIT attitude. Do these directors and managers have the right attitude dealing with investment and people? Are they good leaders? You can also read articles about these directors and managers to understand more about them. An important source of information is the annual report. Read a few annual reports, you will have a feel about their people and their directions. Another thing you can do is to attend the AGM or annual general meeting of the REITs to have a better understanding. As in that meeting, you can hear them talk and can ask them questions. The past performance is also a good reference to assess the people of the REITs you want to invest in. Under their leadership, how did the REIT perform? Are they growing in terms of revenue, profit, and importantly the earning and dividend per share? Once you have qualified the people, you will have a very good list of a few good REITs that you can invest and grow the money with. However, if you buy in a REIT at a high price, you may not earn a lot. Our approach is to buy into a good REITs at a reasonable price. To do this, you will need to learn a bit about finance and how to calculate some of the important financial ratio. The first one is P ratio or price to earning ratio, which is calculated by dividing the stock price or share price by the earning per share. The earning per share is the total earning, or net profit, divided by the number of outstanding shares. Our rule is the P ratio should be less than 20, as a good entry price. The second ratio is PB ratio or price to book ratio, which is calculated by the share price, divided by the book value per share. The book value per share is the net asset value of a company, which is equal to total asset minus total liability, divided by the number of outstanding shares. For a rule of thumb, the PB ratio should not be more than 1.2. The third ratio we need to care about is the debt ratio, which is calculated by the total liabilities, divided by the total assets. For debt ratio, we would want it low at less than 0.3 or 30%. Other than the above three key ratios, one important factor to assess the REIT is the ability to grow, which is shown by the growth in revenue, growth in profit and especially growth in dividend per share. We would expect the REIT has a positive growth over the year. It is important to note that REITs normally don't grow very fast, as it needs to distribute 90% of its earning back to investors, hence has little money to reinvest. However, under a good management, we do see REITs that grow at 5 to 10% per annum. For simplicity, we can refer to a financial website like Morningstar.com to find out the key ratios of the REITs and also their growth rate. Combined all the ratios above, we will have a pretty good entry price for investing into a REIT. Of course, the past performance does not guarantee a good future performance, however, using such assessment will give us a much better chance of buying into a good REITs that help to grow our wealth. Some of the final notes on REIT investing. 1. Using this strategy, you are investing into stock market with a property investor's mindset. By doing that, you can combine the strength of a property investor with the advantage of share investing and professional property management. 2. You will need a good financial understanding to be able to read the financial report and related matters. It will also help you to become a better property investor, which is not the scope of this course. We encourage you to take up another course to read and understand financial report. 3. Although it looks considerably less physical work compared to owning a real property, owning a REIT stock is not just about buying and selling. It is more on monitoring and reviewing the performance of the REIT and its management. REITs can release quarterly report to you as an investor, however, we would recommend you to assess and make decision on a yearly basis to avoid impact of temporary factors. 4. As a REITs investor, you are exposed to more complicated property types, hence market and industrial changes can have a significant impact on your investment. It is important to keep yourself updated with the changes, and the major trend to make adjustment in your investment portfolio.